Lowe's companies. Ticker symbol Lowe stock. A home improvement company with more than 2,200 stores across the USA and Canada. Lowe's is known for the dividend and they have increased the dividends for 58 years in a row. Really impressive. But is Lowe stock also a buy right now? Let's find out. So in this video I will show you everything you need to know about Lowe's companies. I will show you what Lowe's does and I will show you my fundamental analysis to see if Lowe's stock is a buy or not. I'm also going to compare Lowe stock to the main competitor, Home Depot. I'm very excited to see what you guys think about Lowe stock. So please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. What does Lowe's do? So, Lowe's is a home improvement store and they serve more than 90 million customer transactions per week in the United States and Canada. Lowe's operates or serves nearly 2,200 home improvement and hardware stores. Lowe's main competitor is Home Depot, which we will discuss and compare later in this video. If we check the home improvement market size in the US from 2008 to 2025, it's looking great for Lowe's. It's expected that the home improvement market will continue to grow from here. We see a big jump in 2020, which is caused by the lockdowns, of course. In 2025, the home improvement market will be roughly $621 billion. If we check the revenue breakdown of Lowe's, we see that there are three major categories, representing roughly each a quarter of the total revenue. We have building and maintenance, home decor and hardline. One of the things that really caught my eye in the investor presentation is the transitioning from store delivery model to a market delivery model. So here we see the traditional model and how things are going. And here we see the new model where the focus is on driving operating margin expansion, incremental sales, improved inventory turns, and a better customer experience. This is something that's really important. Companies like Lowe's and Home Depot have a lower profit margin in general compared to other companies or other industries. So when Lowe's is able to increase the profit margin, then this could be a huge moat for them in the future. If we check 2022 financial outlook, we see that Lowe's expect a 94 to 97 billion sales with a comparable sales of -3% to flat, which is something to keep an eye on. The financial outlook for 2022 is a bit weak. Operating margin is likely to be between 12.5 and 12.8%. The EPS and capital expenditures is looking fine by me. Lowe's is going to spend roughly 12 billion in share buybacks, which is a great thing. But we will discuss this later in this video. Same story as with the return on invested capital or ROIC, which is likely to sit around 35%. Lowe's has a 15 billion cash available for enhancing shareholder value. This is divided into three categories: return on invested capital, where the focus is on profit enhancing projects; the dividends, where the focus will be on a target payout ratio of 35%, which we'll discuss later in the video; and as I said a minute ago, a share buyback of 12 billion. If we check the financial highlight of the fourth quarter in 2021, their most recent announced results, we see that there was a 21.3 billion in sales, which is a 5% increase year over year. Next to that, there was a 5.1% in comparable sales growth, which is very important for a retail company. And the interesting part is that in the fourth quarter, the operating margin was sitting at 8.67%, which is quite low. But we saw earlier in this video that Lowe's is focusing on increasing the profit margin. So that's going to be a huge thing for 2022. Diluted EPS is up 35% year over year and sitting at $1.78. So now that we know a bit more about what Lowe's does and how they performed most recently and what the financial outlook in 2022 looks like, it's time to check the historical stock price. As mentioned earlier, the main competitor of Lowe's is Home Depot. If we check the 5-year chart and compare Lowe's with the S&P 500 and Home Depot, we see that Lowe's has made the highest return of 146% over the past 5 years. The S&P 500 did return 92%, and Home Depot did return 105%. So Lowe's did outperform both of them big time. But on the 1-year chart, we see that Lowe's did only return 5%, while the S&P 500 did return 13%, and Home Depot lost 1.9%. On the 1-month chart, we see that Lowe's is down 8.6%, while the S&P 500 has gained 5.5%. Home Depot is also down 5.7%. So right now, the two biggest home improvement stores are all going down a little bit, while the S&P 500 is going up. This also has to do with the financial outlook of both companies, which is a bit weak. Next up are the fundamentals of Lowe's. Lowe's is a 145 billion market cap company with a PE ratio of just 18. The forward PE ratio is sitting at 16. The other metrics look all fine to me. As said before, companies like Lowe's and Home Depot have lower margins. The operating margin is sitting at 12.7%, and profit margin is sitting at 8.7%. Normally, this is too low in my opinion for a company in general, but you have to keep in mind the industry average. Next to that, earlier in this video we saw that Lowe's is focusing on increasing the profit margin, which is a great thing. Return on assets is sitting at 16%, which is fine by me. The 12th trailing month revenue is sitting at 96 billion, and quarterly year-over-year growth is sitting at 5%, which is fine by me. If we check the revenue growth of Lowe's over the past years, and we see that every quarter the revenue is increasing. From 2019 to 2020, the increase was nearly flat, and then the lockdowns came, which led to a massive increase in revenue. It's likely to increase from here as well, but not as in the same ratio as it did last year. When we check the balance sheet, we see that Lowe's has a total cash of 1.47 billion and a total debt of 29 billion. This tells me that the total debt is way too high compared to the total cash, so this is a thing to keep an eye on. Operating cash flow is sitting at 10 billion and levered free cash flow is sitting almost at 7 billion. It's really important for a company to have an increasing free cash flow because free cash flow is used to pay down debt, buy back shares, pay dividends, do acquisitions and all other kinds of things that led to an increase of value for the investor. In this graph we see that the free cash flow is going up really hard and that's a good thing, but also a thing to keep an eye on. Are they able to maintain this free cash flow growth? One of the things I like the most about Lowe's is that they buy back a lot of shares, which we see here. It's really important for a company like Lowe to buy back shares because this means your share becomes more valuable. The EPS is going up and this attracts other investors. Next to that, when the total shares outstanding is going down, less dividends have to be paid. This means it's easier to maintain the dividends and of course increasing them. Here we see that the total dividends paid is going up, but this is because of the increasing dividends. Right now it's sitting at almost 2 billion, while the free cash flow is sitting at 10 billion, meaning they have more than enough free cash flow to support the dividends. When we check the dividends, we see that Lowe's pays a 1.85% dividend yield at an annual payout of $3.2 a share. Payout ratio is sitting at 25%, and earlier in this video we saw that Lowe's aims for a 30% payout ratio in 2022, meaning an increase of dividends is likely to come in the next quarter. The 5-year compound annual growth rate is sitting at 17.67%, and Lowe's did grow the dividends for 58 years in a row. Really impressive. Here we see that there was a big increase in dividends in 2021 in the first quarter. So as I said a second ago, it's highly likely that in the next quarter Lowe's will increase the dividends again. So, now that we know everything about Lowe's, it's time to compare them to Home Depot, their main competitor. Lowe's is a 133 billion market cap company, while Home Depot is a 311 market cap company. Home Depot has a higher dividend yield right now, sitting at 2.5%, while Lowe's has a 1.58% dividend yield. But Home Depot also has a higher payout ratio, sitting at 44%, while Lowe's is sitting at 25%. The compound annual growth rate is similar, but the consecutive years of dividend growth is absolutely best with Lowe's 58 years in a row. Home Depot did increase the dividends for 13 years in a row. The PE ratio is somewhat similar to each other, but Lowe's is just a little bit lower. The revenue growth year over year is definitely higher with Home Depot, sitting at 14.4%, while Lowe's is sitting at 7.4%. The forward revenue growth is also higher at Home Depot, so Home Depot is definitely the winner here. But a very interesting thing is that Lowe's has a net income compound annual growth rate of 54% in the last 3 years, while Home Depot only has a 13.9%, a huge difference. It's the same story with the EPS and leverage-free cash flow. Lowe's is definitely the winner in this part. Margins are similar to each other, but Home Depot has a higher net income margin. Return on assets and return on total capital are also really close to each other. The last thing I want to discuss is the balance sheet. We see that Lowe's has a high total debt, but here we see that it's the same story at Home Depot. So, my final conclusion is that I really love Lowe's, but I also love Home Depot, and that's why I have shares of both companies. The business is so easy and they are here for a long time already, and it's highly likely for both companies to grow even further from here, as we saw with the home improvement industry forecast. A thing that I really like is that Lowe's is focusing on increasing the profit margin. This will also mean a higher free cash flow growth. We also saw that revenue is growing, but the financial outlook for 2022 is not the greatest, to be honest, and nearly flat. But with increasing margins and an increasing industry, I don't worry at all. One of the main reasons I own Lowe's and Home Depot is because of the dividends and the dividend growth. Both companies love to increase the dividends and the stock is returning a lot of value back to the investor. Right now I'm putting a buy sign on Lowe's because it's a simple business which is still growing and has a great dividend growth. I will definitely add more shares of Lowe's and also of Home Depot to my portfolio in the coming months. And I can't wait to see the dividend increase in the next quarter for Lowe's. So, right now I'm very bullish on Lowe's. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.